So in this video, I'm going to be talking about share repurchases, and as always, I'm going to be going over an example. So I'll quickly read over the example right now. So it says chalk dust disposal has $10 cash, operates an incinerator that generates cash flow for $5 per year in perpetuity, starting in 1 year. It's all equity finance. Its shareholders required a rate of return of 10%, and there's 100 shares outstanding. The company just announced a $10 share repurchase, and it'll use all of its cash. It will buy the shares at the prevailing price prior to the repurchase announcement. So what is the share price before the repurchase? What proportion of shares are repurchased? And what is the share price after the repurchase? So there's three parts to this question. I really want to focus on the first and the third part. The second one's not really that relevant for now, but I'll definitely solve it as we go along. So it says, what's the share price before and after? So we're just going to start solving this here. So the value of every company, as you should know by now, is the present value of all of its future generated cash flows. And in this situation, we also add the excess cash that a company has. So for our situation, I'm just going to, actually I'll increase the font so it's a bit easier for you guys to see. So we have valuation. So we know that as of right now, the company is expected, or this incinerator is expected to generate free cash flow of $5 per year. And from corporate valuation, you know that the value of a company is the present value of all of its future free cash flows. So right now, I'm not going to enter these numbers into a different cell, but I'll just point out that we have $5, and since the actual cash flows start a year from now, this works out perfectly because we simply divide that by the cost of capital, which is given to us as 10%, or 0.1. So we get that, and that should give us $50. So the company's worth $50. But I also mentioned that we have to add in the excess cash that we have. So I'm just going to rename this. I'm just going to say basic valuation and plus the cash that we have on hand, plus cash, and the cash we have is $10. So the total valuation we get is actually the sum of 50 and 10. So the company is worth $60 right now. So the equity of the entire company is $60. We want to find the price per share. It's a very simple calculation. So you have price per share as 60 divided by, there's 100 shares. So 60 cents per share. And I'm all doing this sort of a bit more rough. I'll zoom in here so it's slightly easier to see. So the price per share is 60 cents right now. Makes sense. But now what the company is going to do, it's going to use all of its cash, the $10 of cash that it has, and repurchase at prevailing market price. We just calculated the value of the company as 60 cents, and for the simplicity of this question, we assume that the prevailing market price is 60 cents. So we have $10, and we're going to repurchase as many shares as we can, and we know that the shares are priced at 60 cents. So what we can do is to simply first let's calculate how many shares we can actually repurchase. And that should be simple. Let's say you have $10 and you want to buy as many shares as you can and each share is 60 cents. So we'll simply I'll put shares that can be repurchased. And that's simply we have $10, so the $10 in cash, or I'll just type it out specifically, $10 in cash divided by the 60 cents. So we can actually repurchase this is not a dollar amount, this is just a general number that we have. We can repurchase 16.67, but for simplicity, I'm just going to round it off to 17. So we can repurchase 16.67 or 17 shares with the $10 of cash that the company has. So this next part of this question is, what proportion of shares are repurchased? Well, we know initially that there were exactly 100 shares outstanding, and with the $10 we have for the repurchase, we repurchased 17 shares. So 17 divided by 100, we repurchased 17% of the shares that were total outstanding. So that's a simple calculation, doesn't need much explanation. But the third part is sort of the most tricky one, and the one that you need to understand the most, is how a stock repurchase affects the price of a company. And here is one of the most fundamental things I'm about to point out right now, is that when a company repurchases shares at the prevailing market price, which here it does, there is no effect to the stock price. Now you can just take my word for it, but I'm actually going to prove it to you right now. So what happens when the company actually repurchases $10 worth of shares? We know that it's prevailing market prices, and now I'm trying to prove to you, the viewer, that this price per share is not going to change. So what's going to happen when you repurchase? The first thing that's going to happen is you are going to run out of this $10. So you're using these $10, so they're used up now to repurchase shares, they're gone. So the total valuation of the company is technically now only $50. Makes sense? But also remember that even though you've used up the $10, those $10 were used to repurchase shares out of the 100 that were there. So instead of dividing it by 100, this was the amount of shares outstanding. This changed from 100 to, I'll try to be precise, 100 minus 16 or minus 16.67, or I'll just put 666 or like a bunch of times just to make sure it's more accurate. And lo and behold, we actually end up at the exact same number again. And this is not just a coincidence. It's actually one of the most fundamental things you need to understand about repurchases, is that when a company repurchases something at prevailing market prices, there's no shift in wealth. So if you look at a company as a single unit, it uses part of its value, part of its valuation came from the cash. It used part of that valuation, repurchased it, but that change, that sort of lessening in valuation, the $10 was lessened, but that was equally offset by the change in the number of shares outstanding. So on a net basis, the company's value did not change at all. So that was an example on what happens when a company repurchases shares at prevailing market prices. And in the next video, I'll be talking about what happens if a company tries to repurchase shares at a price higher than the market price or a price lower than the market price.